welcome to our April 2024 edition of Macro and Market Wrap-Up. March 2024 was a turning point for the Indian stock market. For last few months, we had been consistently pointing to the over-exuberance and valuation excesses in the Indian small and mid-cap space. Finally, some correction was seen in this space in March, triggered by the SEBI's warning over valuation fraud down the capitalization curve and asking the mutual fund industry to undertake a stress test and publish it for its funds. Month over month, Nifty and Sensex rose marginally by 1.6% in March, while BSE Small and BSE Mid Cap fell 4.6% and 0.1% respectively during the month. March correction aside, FY25 was the year of small and mid caps. We have seen 29% return in Nifty, 25% in Sensex, and a handsome 60% plus in BSE small cap and BSE mid cap. That's a strong outperformance. First, coming to the stress test on mutual funds. SEBI has mandated this as a necessary disclosure, which is good, as better disclosure hopefully leads to lesser investor misgivings. But investors need not be overly worried. Mutual funds in general are always cognizant of liquidity issues. Now, if we speak specifically for our small and mid-cap fund, our liability profile is highly distributed, making redemption less of a risk. It's not the first time we are seeing a fall in small caps. AMFI data shows that the worst net redemption in the worst small cap fund across the sector was less than 2% monthly cumulative in last 10 years. For more information on this, you could refer to the Money Control article by our CIO. The link is mentioned in the description below. Despite some correction in March, our asset allocation strategy continues to stay cautious on Indian equities, with a bias against the small and mid-cap. The valuation excesses hasn't been entirely corrected. It is more of a stock picker environment than getting top-down positive on equities. Macro data points to some shift in growth sectors for India. At the margin, we are slightly more positive for exports for immediate few months and bearish on infrastructure ahead of election. Consumption remains the pain point. Real estate and private sector capex outlook stays positive. The election dates has been announced. Market already believes that the current ruling party will return, so the victory has been priced in, though there are some speculation on the number of seats. But it would take a real downside surprise for the market to be shaken by the political outcome. Results are for June 4th. Now, with the Model Code of Conduct, no new announcement can be made. More than election, we think final budget will entail trigger points for Indian equities via tax modification. There could be likely tax modification post-election. Remember that the government could not modify taxes during the interim budget. This is a risk for Indian equities. Coming to the fixed income, during interim budget 2024, projected GSEC supply was around Rs 1 trillion less than anticipated. Further, during Jan-Feb 2024, SDL supply was just 73% of stated calendar. Both these factors led to a massive spread compression in the long end. The rally was particularly sharp in the 15 to 30-year GSEC bucket. Yield curve today is flat in 1 to 10-year segment. In the last 3 weeks of March, as GSEC supply exhausted and assessing the demand momentum, states have significantly ramped up the supply. SDL supply in March was nearly Rs 2 trillion, 30% more than the calendar and 20% of the full year supply. Consequently, FY24 SDL supply now stands almost equal to the amount laid out in the budget, versus a 20% undershoot in FY22 and FY23. Despite such sharp jump, interestingly, SDL spreads versus GSEC stays unhindered at nearly 40 basis points. Overall, markets' appetite for the long-end bonds have been quite robust. We would once again reiterate that the overall supply-demand dynamics for Indian bonds look quite favorable this year and could warrant a spread compression in the long end. After JP Morgan, India also got included in the Bloomberg Emerging Market Bond Index. Though the funds tracking the latter is quite small, it paves way for more indices to include India in coming years. There has been a shift in liquidity scenario too. Between September 2023 to Jan 2024, overnight rates traded closer to MSF rate, effectively implying a pseudo 25 basis point rate hike in the economy. Since Feb 2024, aided by strong repo auctions, higher FX inflow, and rundown in government cash balance, overnight rates have largely traced back to repo levels. We are sanguine on India's inflation outlook and expect it to moderate to near 4% level in few months. Weather conditions are getting favorable, with projections of El Nino ending and La Nina possibly starting over the next few months. The end to El Nino alone is favorable for Indian monsoon. Further, liquidity could potentially ease May onwards as currency leakage reduces and external account dynamics possibly remains favorable. We think $45 to 50 billion of balance of payment surplus can be easily absorbed by RBI without prompting any need for OMO sales. Such level of balance sheet and reserve money expansion may be commensurate with India's growth. Now, adding the global context. After 17 years, Bank of Japan hiked its interest rate by 10 basis points, shifting from the 8-year-long negative interest rate policy to now 0 to 0.1%. They also abolished its yield curve control policy, along with reducing the purchase of Japanese government bonds, thereby rolling in the tapering measures. Rising wages and tight labor market conditions have led inflation to stay above 2% in Japan. Japan was the last developed market central bank to join the hiking party. Globally though, the tide has turned, with Mexico and Switzerland central bank the latest to join the rate cutting club. But the main act has yet to start, with most G10 central banks still waiting patiently. They know that the policy is restrictive, but with inflation outturns no longer surprising on the downside and growth in many economies proving more resilient than feared, they seemingly have time on their side. They are watching the data and waiting to become more confident that inflation will continue to head down to target on a sustainable basis before easing. Reading the data tea leaves is not getting any easier though. In that context, March Fed policy can be viewed as dovish. Ahead of the policy, a small portion of the market also feared the possibility of Fed guiding for a reduction in 2024 rate cuts possibility. And yet, Fed continues to estimate 3 rate cuts in 2024, citing that 2 months of upside surprise in inflation could not be called as a trend. The biggest change to the policy guidance was on the Fed's balance sheet policy. Fed indicated to slow the pace of quantitative tightening. While at the margin, this is positive for global liquidity, yet there is a high possibility that QT could continue for next 1.5 years at the least. but lowering the pace of QT and continued 3 rate cut expectations cheered the global equity and commodity market. We continue to think there is a serious possibility that 3 rate cuts may not come, judging from the near-term outlook on inflation, employment, and activity. A resurge in commodity prices is another risk to the outlook of 3 cuts in 2024. We expect 10-year USD to average above 4% for 2024. But still, the policy rates have definitely peaked, and the next move is most likely a cut. Now, that coupled with the outlook on domestic CPI could trigger rate cuts expectation in India too. Given the yield curve and liquidity outlook, we are slightly more positive on the shorter end in the Indian fixed income space. Overall, macro perspective is far better for Indian fixed income with better GDP growth, fiscal consolidation, tax buoyancy, BOP surplus, and tailwinds for bond inflows. Despite strong dollar inflows, rupee weakened a bit in March alongside other Asian currencies, triggered by weakness in Chinese currency. In past videos, we had detailed our outlook on rupee. We maintain a marginal depreciation bias and expect rupee to trade closer to 84 against US dollar by end 2024. That's it for this month. Signing off. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.